Let's take a look at this problem, which deals with preparing adjusting entries. It's problem 4-5A. We're looking at a review of the ledger of Napier Company at December 31st, 2010. And we have 4 pieces of data that we'll take a look at in more detail on the next few slides, not on this one though. And the instructions at the bottom says prepare the adjusting entries to reflect these transactions. So let's go ahead and look at these individually on the next slide. Okay, the first transaction said we have prepaid insurance of $15,200. The company has separate insurance policies on its buildings and its motor vehicles. Policy P4-5A on the building was purchased on July 1st, 2009 for $9,600. The policy has a term of 3 years. Policy A2958 on the vehicle was purchased on January 1st, 2010 for $7,200. This policy has a term of 2 years. Okay, now you see the answer in front of you on the screen. On December 31st, we debit insurance expense for $6,800 and credit prepaid insurance for the same amount. Now, how did we come up with that amount? Well, $9,600 was purchased July 1st of the year earlier for $9,600. It was a 3-year policy. So we need to record 1/3 of the cost of the $9,600 policy and reflect that cost as an expired cost. Expired costs are also known as expenses on the income statement. So that's where we come up with the $9,600 divided by 3, or $3,200. Then we need to add to it $7,200 divided by 2. $7,200 was the policy we had on the vehicles as of the beginning. Next, we look at the second transaction, and we know that the company had recorded unearned subscription revenue of $29,400. The company began selling magazine subscriptions on October 1st on an annual basis. The selling price of the subscription is $30, and a review of the subscription contract revealed that 280 subscriptions started on October 1st, 300 started on November 1st, and 400 started on December 1st. So the total number of subscriptions that started during 2010 was 980. Okay, now you see the solution, and what you see is we are transferring from the unearned subscription revenue to the subscription revenue $4,600. In other words, we are reducing our liability of unearned subscription revenue and recording subscription revenue that was earned during 2010. And how we do that is we look at each number of subscriptions that started on a particular date. So in October there were 280. The value of the subscription is $30, so we multiply 30 times 280, and then since it started in October, the months of October, November, and December all should have subscription revenue recorded, and that's why we multiply the 280 times the $30 times 3/12. We go through the same procedure to calculate November and December subscription earned. Only what you will see is, of course, the months go down by 1 for November and go down by another 1 for December, so that we're recording 3/12 for October subscriptions, 2/12 for November, and just 1/12 for December. The company also has $40,000 of notes payable written on its balance sheet. And this balance consists of a note for 6 months at an annual interest rate of 7% dated October 1st. Okay, now you see the adjusting entry we need to prepare related to the notes payable. We need to record the interest expense that we incurred on the note, even though we haven't paid the amount. So we take the $40,000 note, we multiply it times an interest rate of 7% that was given in the terms of the note, and we multiply it times 3/12. The note was dated October 1st, so we need to accrue interest expense for October, November, and December. The company has salaries payable of 0 written on its balance sheet, but it has 8 salaried employees. Salaries are paid every Friday for the current week. 5 employees receive a salary of $600 per week, and 3 employees earn $700 each per week. Assume December 31st is a Wednesday. Employees do not work weekends. All employees work the last 3 days of December. Okay, now you see the adjusting entry we need to record to show the company's obligation to pay its salaries as of December 31st, 2010, and also to record the salaries expense it incurred during 2010. So we take the 5 employees times $600 per day times 3/5, right? They work 5 days, they've already worked 3 days, and that gives us $1,800. Then we need to take the other 3 employees that make $700 per day, and they worked 3/5 of a week as well, so they earned $1,260. We add those $2 together, and that's the amount that we need to record as both salary expense on our income statement, which will be reflected on the income statement, and then also to record our obligation as of December 31st for salaries that were accrued but not yet paid.